Hi. Good morning, good afternoon, good evening, depending on where you are in the world. And welcome to Khaitan and Company's webinar on emerging trends in the insurance M&A space in India. We're very fortunate to have a very distinguished panel with us today. So starting with Nina. Nina Zhu is a managing director and regional head of principal investments and acquisitions in the group asset management division at Swiss Re. She's a good client of the firm. Nina's had a long career in investment banking in the US and Asia with a number of investment banks, large investment banks, before moving to Swiss Re. And at Swiss Re, she's led a number of very successful investments, and she's very knowledgeable about the sector. So thank you, Nina.
Hi, everyone.
Kamesh Goyal is one of the leading figures in the insurance space in India, and we're very fortunate to have him on this panel. He is, as you know, the founder chairman of GoDigit, one of India's fastest emerging players in the digital insurance space. And he's had a long and distinguished career in the insurance sector before that, including a very distinguished career at Allianz. Thank you, Kamesh. Ed Northover is a corporate partner with Debevoise & Plimpton, who heads their financial insurance group practice in Asia. He is recognized as an expert in the insurance space, and he's worked on a number of very significant transactions in the sector in Asia, and he's also worked on a number of transactions involving India as well. So, very pleased to have him on board. So thank you, Ed. Arvind Venugopal, our last panelist, is a corporate partner in our firm in Khaitan. He specializes in corporate M&A with the focus on insurance. He's acted on several large M&A insurance deals in the sector, and is a very important part of our insurance M&A group. As to myself, I'm Nikhil Narayanan. I'm a corporate partner in the Delhi office, and I'm one of the partners in our insurance M&A group. So quick word about our insurance practice before we move on. As you know, Khaitan Company is one of India's biggest and leading law firms, pan-India capability. We have a specialist insurance M&A team with partners in Bombay, Delhi, Bangalore, and we've been fortunate enough to act on a number of the leading transactions in this space. So without further ado, I'd like to thank the panel once again, and let's dive into the topic. So to set the scene, we have quite a broad area to cover today, emerging trends in insurance M&A. So just to recap before we dive in, so much has happened over the last few years. You've had, back a few years now, you've had the increase in FDI to 49%, with some possibility and speculation that it may increase further. 70%. There has been the explosion of bancassurance as a key distribution channel, replacing a number of other distribution means before. There's the whole digitization push, which is happening globally, but in India, we're starting to see that, and Kamesh is at the forefront of that. We've seen PE investment in the space grow, so it's not just strategic investment anymore. And we've seen areas beyond life rapid growth, so areas like health and general insurance. So much is going on, and there's quite a lot to talk about. So I'd like to start with you, Ed. As a partner in Debevoise and having acted on so many transactions, in Asia and perhaps more broadly, what are the trends you see in insurance M&A in other markets? What's driving deals?
Thanks, Nikhil. Yeah, interestingly, given COVID and given the challenges of 2020, it's been a very busy year. There has been an awful lot of activity going on amongst insurers, particularly in Asia where I'm based, international insurers, regional-based insurers, and local insurers, all involved in M&A transactions. I think there's been a number of key themes driving that. I'd say one is something which was happening already, but I think which COVID and the challenges of this year have exacerbated, which has been insurers focusing more on their key markets and seeking to exit from markets which are less important to their overall footprint. And the other side of that, which is the insurers wanting to focus more and get more scale in certain markets which they view opportunities as being in. So not that long ago, we had a lot of, particularly the multinationals were going around and doing a bit of flag planting in different countries, and it was important to have an office in every, a big selling insurance in pretty much every country. Now I think there's much more of a consolidation, focus on countries where you think there is longer term growth, exiting from those countries where there's a bit more of a capital challenge, or for example, if IFRS is going to present particular challenges because of the nature of some of the products the insurers have sold in those markets in the past. So that kind of consolidation has been going on, and I think probably driven more by COVID sort of exacerbated some of that. That's the first. I think the second, again, is a continuation of another trend that we've seen, and maybe something which I think comes to India, and you guys will talk about too, which is banks which have insurance companies continuing to exit that space. Partly, it's been on the horizon a long time because of the capital pressures and capital requirements of running a particular life insurance company, and that's becoming less attractive to many banks. And then, of course, the present situation and capital pressures have made that much more exacerbated. So that trend, I think, will continue. And then that flows through into the other trend, which is continued throughout 2020, which is a focus on distribution. So, for all insurance companies, it's important to be able to find markets to get to. New customers, and distribution through other people's channels has been a key part of that. The banks, as part of their exit strategy, they can exit their selling of insurance products and then become a distributor of insurance products. So swap manufacturing for distribution, and that's been a trend that continues. And then I think a little bit more local to where I am, the other trend that we're seeing is, particularly in Hong Kong, is an interest in Hong Kong, despite all the pressures that we've had in Hong Kong recently, which have been well publicized politically, because of the potential Greater Bay Area in China, and the insurers getting excited about the access we might get to Guangdong and cities in Guangdong through being in Hong Kong. So I think it's been an interesting year. A lot of deals, I think, falling over, unfortunately, because there's uncertainties in the market, interest rate pressures putting a lot of pressure on valuations, and sometimes, have to be frank, there's a mismatch in valuation expectation between sellers and buyers. But I think many of those trends you probably have also been seeing in India as well.
No, you're right, and interesting to hear that in some ways a sort of pullback from the investment approach earlier. Maybe the consolidation aspect is driving insurance M&A, as you say. Arvind, how does that sort of play into what we're seeing in India? What are we seeing here? Does it gel with with what's going on globally, or do we have a different dynamic here?
I think so. I think it. Excuse me. I think it sits in nicely with what Ed just explained. I think in terms of India, there are two broad themes that we are seeing. One is a lot of tech and a lot of focus on insurers and intermediaries who are focusing on tech. There is a lot of activity in terms of fundraising, interest from all sorts of both financial sponsors and strategic players in these tech-driven insurance businesses, especially on the general insurance side. There is a lot of activity going on there, and I think that sort of sits with the way Ed explained that there is a relook at banks as a channel for selling insurance, and people are sort of realizing the limitations of that, and to that end, all of these tech-driven insurers are seeing a lot of momentum, and I think that trend is likely to continue for some time in India as technology sort of takes a larger role, takes over a larger role in the insurance and financial services space in general. I think the other important trend that we are seeing in India is again a sign of maturity of the market after 20 years of liberalization. I think the industry has reached a place where people are clear in terms of what is their long-term outlook. So we've seen some situations where existing players have consolidated, and I think that's again a trend that we will see more in the future. As Ed mentioned, there is a tendency to sort of focus on core competence and focus on markets where people can do well. So again, that's something that we see going on for some time, and that's already started happening. The last sort of significant trend that we see in India is, of course, promoter stress and coupled with the fact that foreign investment is still capped at 49%, it's a very interesting situation where there is a lot of interest from big Indian business houses that have promoted insurance businesses in the past, either on account of stress or on account of focusing on their core businesses. They are looking to exit, and some transactions have already materialized because of these pressures. And I think that's again a trend that we will see strengthen once FDI caps are liberalized and foreign participation in the Indian insurance space is permitted to a larger extent. I think that's broadly the trend that we see in India right now.
Yeah, and so that last point, is a nice segue into the need for international capital. Because obviously, the sector is in need of a lot of capital. India is underinsured. There's no doubt about it. And there's a crying need for capital. There is only so much, to your point, up in the domestic promoters and institutions in India can provide. So the obvious answer is therefore, international investment, whether that's strategic or from financial sponsors. So, but that is obviously in the context of the regulatory environment that we have. So Nina, if I can ask you, how do you perceive, and having done deals in India, being familiar with the Asia region and India in particular, how do you feel about the regulatory environment in India? Does it help? Does it hinder foreign investment? What are the challenges that international investors face when they look at India from a regulatory perspective?
I think with regard to international investors, and I'll put it into two buckets, right? I'll put the first one being strategic, and then the second one being the financials. The strategic investors, they assess emerging markets first and foremost around the profitability and growth trend of that particular sector. And I think for India, if you look at whether it's in the GI space or the life space, we're seeing positive and very progressive movement in that space, right? More and more, the combined ratio is coming down on industry basis, giving foreign investors confidence. There's quality growth. And in the life space, of course, the regulators are coming in with some very transparent ways to help businesses or insurance companies conduct in a compliance manner, all of which I think goes into quite additive to the emotion of investing in a market like India. The structural benefits, or I'd say the structural upside of India, whether it's the growth or closing the protection gap, is really all there. But from a strategic investor's perspective, a lot of it does go down to the underwriting situation and the evolving underwriting dynamics. But then if you look at the second bucket, which is, I call it the PEs or the financial investors that ranges from early stage to late stage, I think the regulators have played a very crucial role. It's, if you look at it comparing to China, for example, the Indian regulator have been quite specific in terms of inviting private equity players to come in, and they've been very active, right? Particularly, we have seen that in the health space, whereas the laws or the regulations in China is open for interpretation, and the proof is really based on the actual fund itself. So it's quite cumbersome. So net, if I would look at it from a regulatory perspective, there is an ease of doing business. There have always been there. I think supported by, you see progressive underwriting metrics, very specific guidelines that makes it much easier. And of course, then you have then the actual merits of the transaction itself. But I would say that where we are today and looking out forward in the near term, we do see a lot of positive trends.
And informative, Nina, particularly the comparison between India and China and the role that the regulator has played, a positive role, as you say. But Kamesh, can I test that? Because set against that positive message, India is still, I think we all recognize, an underinsured market, right? And if I take life, the last life insurer was set up about 10 years ago, a decade ago, and in the last 3 years there have only been 2 new GI registrations. So you having set up such a successful digital venture in this space, what do you see as what's holding things back? I mean, what are the barriers for entry to new insurers?
Sure, Nikhil. So I think if we look back previously, 5-10 years back, most of the insurance companies were promoted by either banks or large industrial groups. Now, I think Arvind has already spoken about that there is stress in both banks as well as in some of the large industrial houses. So you don't really have a new Indian promoter who can actually enter into the sector. Secondly, while I think private equity players have been welcomed by the regulator, but we have not really seen a case where, say, someone like me or a professional could put together a few private equity players and then promote an insurance company. I think my sense is that regulator prefers a promoter to actually own a substantial company and then also say that, no, I'm really committed here for 5 years or 10 years. I think startups, by their very nature, whether in insurance or fintech space or any other, I think they typically work when someone like a founder or a professional, he comes together, develops an idea, brings in some capital, and as the business starts developing well, he brings in more investors. My sense is that the Indian regulator is maybe not um, too too bullish on this sort of approach. So I think the new companies will be very difficult to come by because, as I already said, most industrial houses are already there or they are too stressed right now to get into a new sector. Secondly, I personally feel that even if you look at the last few transactions which have happened in M&A space, due to any reason, there are always more than one bidder. So I personally feel that regulators should actually encourage more startups to come in. And if they don't do well or if they are not able to gain a certain scale, their portfolios can be bought over by existing companies or some new shareholders can come. I think if this doesn't change, my sense is that this dearth of new insurance companies which we are seeing in the market will actually continue in India.
No, that's very interesting, particularly the point about startups and the need for that to service the demand that exists. But picking on that, Nina, I mean, where do you think foreign investment in India in this space will focus? Because again, to the point about startups, data and digital is disrupting everything, right? I mean, data is already very important and probably will be much more important in developing products and managing risk. Do you see that sort of driving investment? Do you see investment into sort of ancillary areas? Where we've also seen a number of investors making direct VC style investments, managing their own money and seeking to leverage some of the growth. So where do you see the pool of money coming in? Where do you see it being allocated to?
Like I think, to be honest, when a market almost explodes in terms of different thematics, and you have a confluence of investors, financial investors, and financials looking at very similar things, there is a lot of noise, right?
Yeah.
So, and I think that noise in itself will be around for some time. As Ed said, I think the COVID situation has propelled a lot of opportunities and awareness in the investor community. And as with any kind of thematic investing, there are going to be tourists who are investors, and they're going to be fundamental investors. So I'm gonna focus on the fundamental investors. I think with regard to overall investment, we do see an evolving, I would say, philosophy as to how you spend that capital, right? It applies to Swiss Re as well when we look at opportunities. I think if you look at insurance, immediately I would say the knee-jerk reaction is I'm going to look at carriers. What we have seen today is I'm going to look at the entire value chain, and I think that's actually fantastic. Because if you look across the entire value chain, the entire value chain itself and this industry will be able to progress and improve. right? Because otherwise the chain is broken. So to your point, if you break down the value chain, there has been a lot of capital going into distribution because ultimately customer is the key and customer is expensive to attain, particularly if you're working with a business model that's heavy in legacy and heavy in people. That I would say that's a thematic that's across not only in India but across the region. The other aspect of it, of course, is automation, and automation is widely defined, right? You can automate on the front end from a pricing perspective. You can automate, of course, in the back end as well. I think the other trend, of course, people are thinking about is more around product development. I know we're going to talk about that later on, but if you look at India as a market, there are aspects of the Indian insurance market where the protection gap is incredibly wide relative to the rest of Asia, for example, health. And with the development and the capital going into the value chain, you actually do see an increase in the overall health product development, which I think will ultimately benefit the Indian consumer. So net, I do see that you have investments going in across the entire value chain. Strategic investors, because you do have license rationing in India, you will see them to be a bit slower and much more, I would say, not cautious, but a lot more sequenced in their thinking, right? Because they only have one silver bullet. And this is not this is a behavior that's very common in countries where you have this license rationing issue. But I think, what you have is an opportunity now with new investors coming in of potential forming consortiums and a diversity of capital coming in as well. But I wanted to also actually add to Kamesh's comment. At the end of the day, what an increasing trend from a regulatory perspective, not just in India, but across the region, is around resilience. We have always thought resilience is around capital. It is much about capital and balance sheet. But more and more now, the regulators are focused on the resilience of the stakeholders, the shareholders, but also the operating framework. So if you think about it, when the overall insurance sector gets much more dynamic with data, with channel distribution, the operating framework itself needs to be stable as well. And that actually would need a diversity of investors with that kind of experience to help keep the framework stable.
Nikhil, I think you're on mute, Nick.
Sorry, I was speaking into a muted mic. Thank you, Nina. I think that was very insightful. I think particularly the point about investment into the whole value chain. And then there's certainly something that we're seeing. And also the fact about resilience. I want to pick up on some of these themes with some of the panelists later. But if I can just go back to something else that you mentioned, the comparison with China and, in terms of the positive the role that you feel the IRDA has played. And Ed, if I can sort of come to you, I mean, you've obviously done so many deals in Asia, and you've also done deals in India. You're familiar with the landscape here. I mean, how do you see the regulatory landscape here comparing to other regulatory environments in the sort of Asia-Pac region?
I mean, look, there are pluses and minuses. The comparison that Nina drew with China is a really interesting one, because most markets around Asia don't have specific rules for private equity investors. Now, in India, you've got fairly well-defined regulations in 2017. China has something in its measures. China breaks things up into controlling, strategic, and financial investors, but I wouldn't say they're as quite as well developed as the Indian rules are. So I think that's certainly, from a private equity perspective, there's definitely a framework there to work within. There are challenges with that we can talk about later, but there's a framework there for it, which you don't see in many other countries. The thing is, one of the things you see around Asia in particular is for private equity and for non-traditional strategic type investors, regulators, it takes a bit of time for regulators to get their heads around that. I mean, they're more comfortable with and strategics who've got a long track record of underwriting insurance policies. And when you have people coming into this who they for private equity, they look at private equity and think, well, particularly for life insurance, your horizons are so small. You're not in this for the long haul. You're going to go after a few years' time. You're looking to make a quick buck. You're not in this for the long-term interests of policyholders. There's a bit of suspicion around private equity investment. I think that's beginning to change globally. I mean, so particularly in the States, we've seen so much private equity investment into insurance companies, particularly as a lot of private equity want to be able to get access to, managing the assets, being able to charge a management fee for managing those assets, and they're good at managing assets, so they sense the income stream. So in the States, we've seen that, and I think it will come to Asia and is coming to Asia. And in that sense, I think India is well positioned, given it's got a framework there. Obviously, on the other issue where India compares with other markets around the region is on FDI. There are other markets in Asia which have foreign direct investment rules. We've got Indonesia, we've got Malaysia, and of course we've got China. China's in the process of liberalizing it, and for the life insurance, a lot of insurers have been very excited about the opportunity to be able to take 100% of their joint ventures. And people want to do that in India. They do, and it's what our clients really want to be able to do, to be able to step up to much bigger stakes. And we've been talking for a long time about a step up to 74%, and periodically getting excited and then being slightly deflated when nothing happens. So we would urge your regulator to start thinking about that, particularly in light of the capital constraints on a lot of Indian insurers. But people do want to be in there. And of course, single presence is the other one. Single presence, I think, is another issue we see dotted around different countries in Asia, which can cause a bit of a headache, particularly in M&A transactions where you I'm sorry, something on. Am I back now?
Yeah.
Sorry. Yeah, sorry. I lost my.
You're back. Yeah. You're back now, don't worry.
The single presence can of course cause issues for people simply because it causes headaches in M&A transactions, which particularly if regulators don't provide flexibility around how long you can hold a second license for if you've done some M&A in the sector. So I think they're all themes that we would see dotted around. The interesting one, which I think probably is coming, is I know India is talking about a move to a risk-based capital regime. That we're seeing that in Hong Kong now. That's obviously come to Europe in the form of Solvency II already, but that presents challenges and opportunities for people, because for some insurers it means they're not going to have to hold as much capital. For others, it means they're going to have to hold an awful lot more capital. So I think that will lead, I think, to a lot of to the extent that moves ahead, it's going to lead to an awful lot of focus on who are best placed to deal with that. But again, an issue that we're seeing popping up all around the region.
No, and to that point, I mean, it's an excellent last point. I think the RBI is very alive to that, and the capital adequacy requirements is something that we'll come to in a second. But we would totally echo what you had to say about the increase to 74%. It's probably long overdue. But Kamesh, if I can just come to you with that sort of backdrop, one of the themes, and we've touched upon it earlier on in this webinar, is the theme of digitization, something that you're obviously very familiar with GoDigit. But where do you see, what role do you see as that digitization will play? I mean, it's obviously a very important role, but specifically, what do you think it is going to do? And where do you see, foreign investment coming in? What sort of buckets are we looking at? Are we looking at analytics? Are we looking at carriers? Are we looking at what are we looking at? And do you see a trend where the footprint becomes as important, because distribution is important? Do you see integration between parties who have frankly no financial services, insurance expertise at all, but they just have a large user base, integrating them with insurers just to provide the digital distribution? Do you see that as driving investment in M&A?
So my sense, Nikhil, is that if you look at capital per se in today's world, my sense is that one should only see capital as capital. and whether it is coming in from a foreign insurer or a private equity player or somebody else, I would say it would not really make a major difference. Most of the large international reinsurers and insurers themselves, they are actually behind the curve in this digitization race. Most of them are actually investing a lot of money in it, and they're also investing in a lot of this fintech and insurtech ventures in terms of trying to catch up. So the way I look at FDI is that if they increase FDI to 74%, then maybe we could invite a lot more capital, including foreign private equity capital, into the market, which is really, really needed. The second point I would want to make is that when we talk about doing something in analytics, tech, or digitization, it is actually quite expensive because when you have to invest in building a business today, you have to build it for scale. Now, scale would come later, but you need to make a huge amount of upfront investment. I think if you look at the case of last 2-3 years or 4-5 years, whatever companies have come, they have already invested in India a fairly decent amount of capital upfront. So I think that's the second thing which is really important. The last thing is that while having a deep customer database is important and it's quite useful, but there is a very big overlap between various companies. Just to give an example, if you look at travel aggregators, if you look at e-commerce players, and if you would look at food delivery companies in India, their actually customer base would be identical. So I think we should not also confuse that just because you have customer's mobile number and email ID, you can actually go out and cross-sell. This hasn't really worked. I think bundling insurance, and we work with a lot of partners in this space in various categories, and coming out with maybe products which are relevant in small way for that particular customer during that transaction. I think that makes sense. But beyond that, I think we are still far too away where this cross-selling, etc., has worked. And this is not true just in India, but across the world, including banks. Lastly, my sense is that though bank assurance has become a dominant channel, I think in India also now regulator is becoming more conscious of some of the downside which bank assurance actually brings as a channel. We have recently seen regulator in the general insurance space come out with a draft circular where they want to ban this bundling of health insurance, critical illness kind of products along with the credit linked products, something which has been banned in Europe and UK and a lot of most of the North American markets already. So I think there is a need for new distribution channels to emerge, and as Arvind said right at the beginning, that this over dependence on bank assurance is not really good from a customer's viewpoint also.
Some excellent points there, particularly the fact that just a user base alone isn't everything, and I think we will come to product development later. I'll ask you for your views a little bit later on, because I think that's, as you pointed out, very critical. But just sort of tacking back for a second to your point that capital is capital, and it should be welcomed regardless of source. And I think what Ed was saying as well about how in other markets private equity is differently regulated. Arvind, if I can come to you, I mean, we've had the PE guidelines now for a few years, right? It's not new anymore. But we've only seen a small handful of meaningful deals, controlling deals. Now, part of that is the FDI issue, but more generally, why hasn't there been greater interest from private equity in acquiring greater stakes? What's holding it back when there's self-evidently such a gap in terms of the need for capital?
Yeah. So Nikhil, I think the largest culprit there is the FDI regime. There is clearly an interest on part of private equities to have a meaningful controlling stake in many insurers. If you would see even the recent assets that have come on the block. Reports suggest that there is heavy interest from private equity players, both domestic and foreign, in acquiring a meaningful stake. And I think the FDI cap is the biggest hurdle there. Having said that, from a private equity's perspective, the way the regulations are worded, the biggest area of concern appears to be that there is a requirement that promoters hold 51% even post-listing. So in a regulatory world where foreign investment is capped at 49%, and post-listing you have to hold 51%, what really are your exit options? So at meaningful IPO is out of the picture because you're expected to hold 51, and if you do 74, that's liquidity of only about 20-25 odd percentage points. And secondly, we are already in a stress market where there aren't as many buyers as there are assets on the market. So in a situation where FDI regime is liberalized, there is clearly going to be greater exit opportunities for private equities to come into the space. And then, of course, if the post-listing regime is liberalized, something similar to what banks currently have, for the promoter group to divest to a non-controlling significant minority stake over a 10-15 year horizon, that would really help private equity make more meaningful investments in this space. I think the two largest areas of concern from a private equity perspective clearly are the requirement to hold a controlling stake even post-listing and the FDI cap.
Yeah, and I think just one of the themes that you touched on, I mean, is obviously also, and was mentioned by, I think, some of the other panelists earlier, was around stress, which we haven't talked about, but, maybe generating a number of opportunities. And I don't think that that's unique to India. There are a number of stressed players, maybe more generally in the Asia-Pac region as well. But Kamish, how do you see this? I know that we're sort of slightly digressing a little bit, but I'd like to just pick on this point. How do you see, because you mentioned, that the regulator is very happy with a promoter-led regime, and even that seems to be the focus of the PE guidelines. Do we sort of need to get away from that with distress? Because as many Indian promoter groups, for various reasons, not all fault-based, are stressed. So, and that's obviously throwing up opportunities. So how do you sort of see that dynamic shaping the way that deal flow will evolve?
So my sense is that I think confusing a promoter with a minimum sort of a equity holding is maybe not required today. I think if you look at some of our other financial institutions, I think if you look at ICICI Bank now or HDFC Bank, etc., I think we have seen big banks and financial institutions emerge, where today maybe, at least in case of ICICI Bank, I don't think anyone would be owning more than 10% equity. So I think end of the day, board management becomes very critical. I think where IDA has done some good work, making board more responsible and empowered. But I think they should really encourage companies to start, which are board managed, might not have one large shareholder. And as the company is doing well in insurance, if they are growing, they'll need capital. They can raise a lot of capital from the market. And if they are not able to grow and they are just incurring losses because of high expenses, at some point in time, they might not be able to raise further capital, and then regulator can actually push them for a portfolio transfer. And these portfolio transfer deals during my stint in Europe, I would say are very common, especially in Europe. And you can close these deals also very, very fast. So my sense is that I think in today's world, the money is there with the private equity guys. I would not expect, especially after this COVID impact on the insurance companies globally also, that foreign insurance groups would have a large amount of capital. So I think that is over. Indian banks are not in that position. RBI is also a bit uncomfortable with that. Industrial houses already have stake or they are not in a position. So I think we should really think about if capital will not come from private equity companies and foreign ones also, then where will the capital come from? So I think the question is not should we be allowed, should it be encouraged? We should say, if not allowed, what is the alternate source of capital? And based on whatever limited knowledge I have, I don't really see any other source of capital in a country like India, which is both capital and investment starved.
Yeah, I completely agree. I think that's absolutely right. We're all, I think, with one voice on that. But coming to something that you said, and Ed, just sort of coming to you for a minute, insurance distribution is obviously regulated in India, heavily regulated with strict IRDA guidelines and sort of oversight. And probably not surprising that that's the case. But given how important distribution is and the fact that it's been identified even on this panel as driving deals, um, how does this compare with other jurisdictions? I mean, what can India learn here? We've had a focus towards open architecture. What are the trends on this?
Yeah, I mean, there hasn't been such a trend towards open architecture in other countries. I mean, bank assurance continues to be very popular in a number of jurisdictions around Asia. We're doing deals all the time, in Vietnam as well at the moment, where there's been a lot of focus on bank assurance. And that I don't see that going away, but of course, and most countries don't have restrictions around exclusivity. So India, in some ways, is a little bit unique in having sort of unspoken rules around open architecture and not promoting the exclusivity. But in some respects, it's more ahead of other countries because that's more that's more in line with what you'd see in some European jurisdictions and so on. With giving customer choice is deemed to be much more important. So I think that trend is an interesting one to follow in India. Other countries around the region, if you take Hong Kong, for example, we've been tidying up our intermediaries regime recently. That's led to a lot of clarification. Of course, it also leads to new questions arising about who is an intermediary exactly. Can you end up inadvertently creating an intermediary of your wife if she offers to give you she gets some kind of promotion on an insurance policy and tries to encourage you to buy it, for example. So again, some of the lessons to learn, I think, are just to make sure that you don't fall into the rules are very clear when you go through tightening up the regime to make sure that unexpected situations aren't created. But a lot of what we're seeing, I think, is just to echo what a number of the panelists have said, which is straight traditional distribution deals, which is a lot of what has been driven in India, particularly because the insurers' joint venture partners are often their bank assurance distribution partners, which creates its own challenges, obviously. But a lot of what we are seeing now is around Asia is a look to alternative distribution. I've done some deals in India as well, where that's been a focus with traditional insurers taking some kind of venture capital or PE style stake in some other entity within the distribution chain. So it's not about necessarily buying carriers, it's about buying different bits of value in the chain, which can help you with underwriting, which can help you reach, we've talked about reaching other customers and how there can be some crossover in terms of, the customer data. But it's not always about just finding new customers. It's also about finding new ways to treat the data that you've got. I've already got a policyholder. How can I find ways to be much more sophisticated to, deal with the data I've got to tailor products that suit their needs? And there are others in the market that are very good at dealing with that kind of data, and those sorts of insurance distribution and SureTech type partnerships, I think, are also quite key. And much of what we're seeing, dotted around Asia, which I think India can be at the forefront of, particularly because if you're making investments in many of these different bits of the value chain, the regulatory restrictions that you get for investing in underwriters just don't apply. So it's much easier to be able to do those sorts of deals. I just wanted to go just very quickly, Nikhil, just back onto the private equity point, because there's a couple of things which we see sitting outside India, which private equity clients see as a problem in terms of investing, or something which they ask questions about. I mean, Aravind was absolutely right to talk about the FDI issue, because the exit is a big issue about trying to work out whether you can exit if you can't sell to a foreigner because the FDI cap is already there. I think there are two other things that we see. One is around interpreting the rules for promoters in terms of having to put cash into a cash-strapped company. Now, at the
Ed, I think you're muted, or there's something wrong with the line. Ed, can you hear me? I think we have a bit of a glitch with connection. Sorry, Ed, do you mind repeating some of that? Because I think the line went bad there for a second, so I don't know if the audience were able to catch that. Okay. Well, look, let's move on. Thank you. Let's move on to the next question. I think Arvind, one of the things that Ed touched on is some of the issues with exclusivity in the distribution regime in India. Can you just touch on for the audience, what the most important distribution channels are, in India at the moment, and the emphasis on open architecture and the IRDA's rules, how that's sort of affecting things, and the key regulatory challenges?
Sure, Nick. I'll just take a second to respond to the point I think Edwin was making in the context of private equity, which is the requirement that the foreign PE is required to bring in more capital to a company which is already distressed because IRDA expects solvency to be maintained. I think that provision is definitely there in the rules, and we can't definitely disregard that. But having said that, if you really see cases of insurers being in stress, and there are two, one that happened very recently. IRDA has always clearly preferred a portfolio takeover. A few months back, a health insurer ran into trouble with their solvency requirements, and IRDA required a general insurer of the group to take them over. So I think because IRDA also understands, or I think somewhere in the back of their mind, they also appreciate that if the company is not doing well, nobody would want to throw in good money after bad. So yes, to the extent that provision continues to be in the statute books, it is a problem. But again, IRDA's practical approach to these things have maybe been more practical than what a bare reading of the rules. But yeah, I completely agree that that's a huge scary thing to be faced with.
It is. Sorry, if I cut out before, I apologise. A bit of an internet issue there. But that was exactly the issue, and I think people like to take a practical approach, and of course, there's been a bit more of a spotlight put on that in the COVID situation, where there's been a lot more capital. The other point I was making, just when I got cut off, I don't know if it came through, was the other issue around the rules, as it were, about investors from the neighboring countries being able to make investments in Indian companies. That's obviously thrown some uncertainty out there as to what that means, particularly if you're from Hong Kong. Are you classed as China, which I think people will say you are, and that's clearly brought some uncertainty about whether those sorts of investments can be made. And even if you make it into some kind of Singapore holdco, which ultimately controls an Indian company, whether you're in dangerous territory there. So some of those uncertainties around rules, I think, have caused some issues with people thinking twice about an investment, even though they want to.
Yeah, indeed, that is a very, very topical issue at the moment, a hot potato. But if I can sort of ask, maybe I can ask this question of both Kamesh and Nina. I guess India was already seeing a move to digital. We were already seeing those trends, and maybe COVID has just accelerated some of that. But we've seen there. You can see from the charts, particularly for life, how dominant bank assurance is. And Kamesh, you asked the question of, is that a totally good thing? But how do you see bank assurance adapting itself to this digital change? If you take a 5-10 year horizon. I mean, is bank assurance versus digital a binary choice? Is it one or the other, or is it complementary that the banks would themselves need to improve their own digital platforms, and in addition to their banking services, could be greater enablers using more digital? I mean, how do both of you, if I can ask for both your perspectives on how you see that?
Nina, you want to go ahead, or?
Oh, sure, I can go.
Please.
Sure. I think with regard to, I guess I would step back. Insurance is a product-centric business, right? And so when we talk about channel, especially now with digitization and data, there is hope that insurance can become more customer-centric. It may never get to a point where it's 100% customer-centric like e-commerce. It is going to be somewhere between. I look at bank assurance channel as as a tool to access a portion of the customer base, right? So the overall customer base is going to be effectively a triangle. And, you know, you can ask, some of the channels are going to be very effective in accessing the lower bottom of the customer base because, you know, these guys probably smaller ticket. They want the easiest thing to understand. And then, you know, I think bancassurance can be very, very interesting when it comes to the emerging mass affluent, because that population, they still do need the human factor in terms of trust. Insurance is incredibly intangible. If you look across all the various financial products and services, there is no emotional attachment to insurance. It's not like, sorry, my daughter wants to speak as well. So if you look at, for example, lending, if you need money, you're going to go to the bank, right? But, you know, I think the emotional attachment of it is quite ambiguous. And so the trust factor is going to be quite helpful. Well, we have seen these journeys actually many times played out, not only in terms of insurance, but actually in some of the other product suites, for example, wealth management. Wealth management as a sector, I think, has evolved to a stage where the bancassurance channel is quite specific. It's for the mass affluent. You offer quite a commoditized product, but at least it is differentiated by the brand and the low cost, right? But it's also a complement to something else you're going to do. And I think bancassurance has a role in that space, and it allows partners who are quite focused on moving up the scale in terms of customer access to continue to prune and screen off that customer base, which ones can grow up or can be elevated to, you know, other purchases to increase that cross-sell ratio. I don't see it as mutually exclusive. I think it's very complementary. But what I do see is very difficult to actually action a complementary distribution channel because the alignment of interest might not be there. And, you know, we all know that bancassurance is a very difficult task to even manage internally because the managers, the actual bank manager's personal alignment may not actually be focused on selling insurance, let alone the organizational framework. So, you know, from that perspective, I do view, especially emerging markets, bancassurance will be a pillar of the distribution, but it has to be very specific in terms of the customer segment you're trying to access, the product you're offering, and that's where I think digitization could be very helpful. You know, you make the products simple for a bank manager who is not educated in insurance to be able to, you know, educate the customer base and then also be able to increase that trust level. You can make it a little bit more, I don't know, fractionalized in terms of the premiums so that it's much more affordable for the emerging mass affluent, right? I mean, there are ways that I think with technology, you can really make that channel a bit more alive than what it is today.
So maybe I think if we look at bancassurance, the way it has evolved in the last 15, 20 years in India and similar to most of the other Asian markets, I think retail lending has really taken off and grown dramatically during this period. So if we look at both life and general insurance, there is big focus of banks on trying to bundle insurance products along with lending. I think I've already covered what are the challenges here. Very high margin products from a bank perspective and as well as insurance companies perspective. Very little value from a customer's perspective. In my view, this has to change. I think the second is where you have relationship managers, which typically would be catering to either wealth management segment and also, especially Indian banks are doing a good job even on the priority customers also. And here we have seen that relationship managers are able to add value because they can offer all financial products to a customer. I think this is really going well. Going forward, I think if banks and insurance companies really have to touch an average customer, I think the data integration between insurance companies and banks has to really take place, where you can actually then offer customer what product can be sold based on what customer already has, what sort of income, demographics, etc., occupation they have, and then try and position a product. Slowly and steadily, I think this tendency to push one generic product across different customer cohorts just based on the ticket size, I think will lose relevance. And by the fact that insurance companies have to put hundred of relationship managers to push sales, I think will also become counterproductive over a period of time. So I think the distribution channel definitely needs a transformation. It will not come from the insurance companies and banks. I think like developed markets, this has to be pushed by the regulator. And the regulator will push this essentially because they would want customers to get a fair deal.
No, very good point there about bundling and pushing products which may have little value to the customers. But on a related point, because given the importance of bancassurance for life, let's talk about life specifically, right? 54% distribution through bancassurance. Nina, I think one of the things is that we've seen that life, general is growing very, very quickly in comparison to life, and if you look at health as a subset as well, health is growing, but life is growing, but maybe not at that rate. Now, is that because India tends to see insurance or life insurance as a savings product rather than a risk kind of management product? And do you think that perception is changing? And what do you see the effect is that has on sort of deal making and M&A in this particular space?
Again, I think the evolution tend to be with regard to savings product. You kind of go from forced savings product, because that's the only thing in the market, right, to precautionary savings. And then it becomes something of an awareness, whether it's created by the carriers or created by the market. And if you look at where we are today, especially with COVID, health has become a huge growth channel. And that part is driven by awareness of the consumers, and of course by the carrier's ability to offer such products. I think it also structurally, if you look at India, you do have a declining interest rate environment. So in terms of relative attractiveness, a pure savings product, may not be that attractive for the consumer either. But we do also see, and India is not alone, you see that it's quite easy for the products to be deemed either too complex, or very commoditized. Even though from a carrier's perspective, everyone is trying to innovate. So, I think the lens has to be almost three different kind of lenses, right? From the consumer side, they want something that is truly valuable for them, that is tangible, but it's also easy and transparent to understand. And most importantly, it's affordable to them. And those three things are tricky to put together, right? From a carrier's perspective, when you have product development, it goes back to the core of what data do we have, what is going to be that product cycle, right, in terms of my losses, and what do I need to do to get much more comfortable around that space. And I think it'll be an evolution, but this is an evolution where you do see greater partnership and collaboration. I agree with Kamesh. I think the insurance sector in general, globally, is actually much slower to adapt and to react to a consumer-oriented business profile. And as a result, I think, insurance companies in particular are going to be forced to collaborate. And they're learning quite fast in terms of how to collaborate. But it's going to be, if you think across the value chain in terms of creating products that the consumer need, particularly in the life and health space, is going to be dependent on your operational partners, maybe potentially a data partner, maybe it's potentially a medical partner or or e-pharmacy partner. But whatever way, that partnership needs to ultimately result in a product that is easy to understand, that the consumer likes, and that is also from a carrier's perspective, some kind of a profitability. So I think there'll be an evolution, and in the evolution you would see equity shares exchanged, and it doesn't have to be even at the carrier level. You could have it at different ancillary channels or or ancillary sectors as well. But that's where capital, I think, will be much more active.
Yeah, and sort of to that point on, customization, Kamesh, maybe I could just get your quick thoughts. You mentioned it as a problem about, lack of innovation or suitable products, designing the right products, not just pumping them out. What are your thoughts on this? I mean, perhaps there isn't enough innovation, but how is that likely to change? And do you see this as driving M&A?
Well, I think I would say the challenge seems to be more on the life side than on the general insurance side, where I think product innovation is continuously happening. I think in life insurance space, on one side we say that the product is long-term in nature. But if you look at the data of the Indian life insurance industry, less than 40% of the policies go beyond 5 years. If you go beyond 10 years, maybe less than 10% of the policies will actually go. So we are essentially, from a customer's perspective, they are actually paying charges from a short-term perspective. So it might actually be better to come out with products, which offer maybe more protection. Term life has started doing really well. And from a long-term perspective, I think insurance companies will have to offer some sort of a guarantee. If insurance companies cannot offer some sort of a guarantee in terms of investment rate or in terms of, I would say, morbidity kind of a situation, then I think life insurance becomes more like asset management product, but just with high charges. So I think life insurance, it's interesting. On one side, you have an extreme where I think countries like South Korea, Taiwan, whole of Europe, where insurance companies lost tons of money because they were giving guarantees and no interest rates really went south. And on the other hand, you have South Asian countries where customer is essentially ripped off. So I think somewhere one will have to find a balance where there are some guarantees, but maybe the guarantees are more transparent for a shorter duration, and they can be, say, linked to a 10-year government of that particular country's interest rate, so that one can adjust the guarantees up and down. If we don't do that, my sense is that over a period of time, just positioning life insurance as a pure savings will do more harm to the insurance companies than what we expect. Having said that, I must say that in India, we have seen a very positive change towards term assurance life, but we need to see products coming in the area of disability. I think annuities still are, I would say, very traditional kind of products. We haven't really seen any different sort of a guarantee structure here other than fixed. So I think there's a huge amount of scope for doing new stuff, especially on the life side.
No, that's really useful. Just sort of mindful of the time, Arvind, if I can also ask you quickly, obviously one theme that we think may drive M&A is the approach of the RBI in relation to banks holding in insurers. Could you just give us a flavor of what's going on in the market?
Sure. So from banks' ability to hold insurers, I think two aspects are important. One are the issues at the RBI level, and the second is the issue at the IRDA level. At the IRDA level, the predominant concern appears to be whether this is an indirect way to compensate carriers over and above the permitted commission rates. And I think there are larger issues associated with those commission rates, and whether it is the right way to create a disincentivized structure around mis-selling, etc. So keeping that aside, as long as those caps remain, IRDA will look at all bank ownership in insurers very, very closely and see whether this is indirectly a way to sort of sidestep those restrictions. From an RBI perspective, I think good or bad, there is more clarity, at least with the recent working paper that has come out on corporate ownership structures for banks. I think RBI is realizing that exposing banks' balance sheets to non-core businesses may not be the best thing to do, and to that extent, that report recommends a 20% cap on bank holding in insurers. So that may be the direction that RBI is looking at, and I think recent transactional positions taken by RBI suggest that. The key here appears to be that RBI would still be open to the financial holding company of the bank, the promoter vehicle really holding the bank, to have a more meaningful controlling stake in an insurer. But again, the unsaid point there is that the capital would probably not come from the bank. So business houses that have banks will have to raise that capital externally, either from private equity or elsewhere, to really invest in insurance. So given the overall dynamics around, challenges around raising capital for insurance companies, it remains to be seen whether that is really going to be successful. How far business houses through a financial holdco structure can raise capital to fund insurance business is frankly unknown. And clearly, banks who've timed it right, who are already in insurance companies, have been able to take the benefit of it. And I think the newer banks who will come in would bear the brunt of it. But I think it's an interesting landscape, and we'll have to see how the regulator reacts to these issues.
So Ed, can I just, to sort of bring this to a close, can I sort of end with you? I mean, we've discussed and you've highlighted some of the pressure points in terms of the industry, the fact that there's greater concentration now, the risk-based capital dynamics, some of the challenges faced by international investors in India, particularly private equity investors, in terms of their exit, the FDI regime, etc. And those all are self-evidently and absolutely the issues. But but that aside, obviously from a regional perspective, what do you think the pluses are for the Indian insurance market? Where do you think things are going right? Where do you think that despite the various challenges, we'll continue to see deals and investments coming in?
I think some of the opportunities lie within many of the challenges that we've just discussed. The issues around capital mean that people, there is a need to bring in new types of investment. We've talked about that in great detail, and I think that is an opportunity for different types of investors to come in, and that's where India, I think, is well positioned. At the end of the day, India is a huge country, a massively underpenetrated market in terms of insurance. Like China, those opportunities remain, and certainly for multinationals and others that want to get access to the market, that is very attractive. It's a bit like Indonesia or China, I say, where it's the potential is huge. And I think some of the regulatory issues have perhaps made people think twice about whether they want to do that. But if we can see a loosening of the FDI, if we can see a loosening of some of the restrictions and challenges that private equity have faced as well, then I think the opportunity is great for bringing in extra investment. I think also it doesn't appeal to all insurers, but I also think that micro insurance, which is something we're seeing in other markets, is a place where India probably has more of a role to play. Much of the micro insurance market did begin in India, but it's obviously become much more prevalent in places like Indonesia and the Philippines. But given many people's only access to, a lot of people don't have bank accounts, but they all have a mobile phone. There's all sorts of ways that you can reach these different markets, particularly with the push towards digitalization. So I think microinsurance might be one way where we could see a bright spot too. Not appealing to all insurers, given that sometimes the low returns on a big capital investment, but something which I think insurers can help to fill a big value, a big sort of protection gap in the market.
Oh, thank you. That's a very interesting point. So look, we've had a very, very stimulating discussion. Thank you for all the panels. Some really interesting thoughts, focus on the pullback and concentration, the fact that investments will come across the chain now, they're not necessarily going to be concentrated. The need for greater capital and the role that private equity will play, and some of the challenges the FDI and the current regime play. A number of interesting thoughts there. So I'd like to thank the panel. It's been a fantastic discussion. So thank you all very much. Really fantastic discussion, stimulating. And now I'll throw it open to questions from anyone listening in. You can write in and submit your questions, and the panel will be able to answer it. Tejas, are there any questions for us that we can address to the panel? Okay, here you go. Sorry, we've got some here. I can see that now. Okay, there's a question. Wow, there's quite a few questions. I'm just trying to filter out. Okay, let's take the most recent one. What's the impact of COVID on the insurance industry? Will there be a fundamental change in the way that the insurance industry functions? What do you see as products and tie-ups being introduced post-COVID? Maybe Kamesh, maybe this is one for you.
So I think when we look at impact of COVID, I would say operationally and ability to service customers, I think insurance companies will definitely invest more. If you look at globally, I think lower investment rates and a lot of losses coming in, especially to general insurance companies based on events and some property insurance coverage disputes. I think the impact on capital has been very high. When I would see it more from an Asia perspective, I would say the impact on capital has not really been much, but we'll definitely see insurance companies investing a lot more in ability to service customers either through self-service or remotely and things like that.
There's another question on what the IRDA can and should do to promote the emphasis of technology and digitization, despite having, one of the largest smartphone user bases. What should the IRDA do to enable this change? Ed, I think this sort of goes to your point on micro insurance. Is there anything that the IRDA can consider here?
I mean, I reiterate the point about micro insurance. I think all regulators around the region are struggling, in terms of trying to keep up with technology trends. But I believe, and you guys are closer to than me, but I believe there's regulations now around sandboxes in India and safe spaces in which you can do, you can test out new forms of technology. I think that's an important step. And if the IRDA can look at some of the more successful regimes to where that's been happening, partly Hong Kong, but probably most of all in Singapore, where the MAS has been very much, I think, at the front, taking on the front foot here in making Singapore a kind of digital center. I think that can only be positive in terms of helping open up different aspects of the market and assisting with digitalization.
No, thank you. Look, I think we're running out of time now, so we're probably at the end of our webinar. So, thank you all very much. It's been a fantastic webinar. So, I'd like to thank the panel. Thanks once again, and hope you enjoyed watching. Thank you.
Great. Thanks, everyone.
Bye-bye.
Bye.
Thanks, everyone.
Thank you. Bye-bye.
Bye.